All the gurus love to talk about passive income, and a lot of investors nowadays have been kind of turned off by it. They hear snake oil and they don't believe it. They think it's a fairy tale that you can actually earn strong returns with passive income. But Denny, you and I have invested our own money in a lot of real estate investments that pay 8 to 16% income yields every year. So we wanted to give 8 concrete examples of different types of investments that we've made over the last couple of years that do pay these high income yields. And we're going to speak from direct experience with our own money, the investments that we've made through the co-investing club and with our own personal money to showcase this stuff. So on that note, welcome to the Bucks Outside the Box show, where we challenge conventional money advice. We get a little contrarian. We try to think outside the box. Denny, do you want to kick us off with the first example here of private notes?
Yes, but I want to add something. I grew up and I was told that purchasing properties and renting them out was considered passive income. And I didn't realize until we looked at things like private notes that no, owning one it was fun at times, but it's stressful and it's not passive. So, with that being said, there are private notes like for a land investing business, and we can be the secure it by having a first lien, and um, yeah, and they pay pretty well. And I learned a lot about land investing from vetting the deal with the club and all kinds of things. So yeah.
Yeah. So to your point, rental properties are a business, whether it's a side hustle business or a full-time business, as a lot of real estate investors do it.
Mhm.
Uh, and it's not passive, right? It's a business. And there's nothing wrong with that. Rental property, rental investing as a business can be a lucrative business if you're committed to it and you learn all the skills required, like any other business. But it's not passive. The rental income you collect from rental properties is not passive income. At best, it's semi-passive, but it's really business income. And your product just happens to be housing. So, kicking off this list of 8 truly hands off passive investments that actually pay you yields of 8 to 16%. Uh, we in the co-investing club, we last year invested in a private note at a fixed interest rate of 15% to a land investor who was introduced to us by another land investor who we know and like and trust. And he has a land investing business, and he put up as collateral his home, his primary residence, which he owned free and clear up to that point. We took a first lien position against his home at 55% LTV, so at a very low loan to value ratio. And we've been collecting 15% interest on that note ever since. And we actually, by pure coincidence, we just had a call with him yesterday, and he's in the process of paying off that note in full with us next week. At the time,
And what he does is he takes land and splits it up. That's it. He doesn't build anything or so I mean, I didn't even know that was a thing.
yeah, and he's not even doing major subdivisions where he's doing, plats and all that stuff. He does minor subdivisions. So anyway, yeah, he has a great business model, but it is a business that he runs. We just lent him money in a private note secured with real property with his own. Okay. Number 2, real estate funds. So here's another example. By coincidence, this happens to be another land investing fund. I promise the rest of these examples will not be land funds or land investors. But yeah, this is just an example that we happen to have done in our investment club, in the co-investing club. Uh, this this guy, he raises capital from investors for his land investing business, not by borrowing money through a fixed interest note, but he has a fund, and that fund is paid 16% distribution yield. It pays distributions every quarter, so basically 4% a quarter. Uh, every quarter since inception, he has paid that out like clockwork. We've invested with him twice now in the co-investing club. We meet every month. We get together. We vet a new hands-off real estate investment together. And he's someone who we've brought back year after year because we've had such a good experience with him. And that high yield investment, that 16% yield, is great to see in your checking account every quarter. See that distribution land there in your account. So
And we don't just do land. if
I
that's
know.
what
Yeah.
you're thinking.
Right. Yeah. So, anyway, moving on from land, um, private partnerships, joint venture partnerships with real estate operators. We've done a handful of those as well. Um, we partnered with a house flipper a few years
Mhm.
back, and we flipped a few houses with him. And one of the things that we negotiated with him was a floor percent, or I'm sorry, an 8% floor return. So, minimum investment of 8%, regardless of how those flips went. Now, one of those flips was a flop, and did lose money. So that floor percent did end up protecting us in that case, where he paid out the 8% floor, the 8% minimum, to us, even though he lost money on that flip. So, as was flipping these houses, we still at least earned that 8% income yield on that, even though the flips didn't work out as well as we were hoping in that
And
particular.
that's a benefit of investing together like that because the amounts are larger. So you can get, better, deals and
Right.
stuff.
So even though each of us was investing relatively small amounts, $2,500, 5 grand, et cetera, we invested so much with him. I don't remember exactly what it was, $500,000 or something. We invested
Yeah.
so much with him that we were able to negotiate that high floor return with him on that. And that's, like you said, Denny, that's the power of investing as a group, where, even though you're investing personally a small amount, you get to leverage that total amount that the group is investing to get better returns, preferential
Mhm.
return than you'd get otherwise. And in this case, like better protections for yourself as well. So that was one example. And that was an example of one that didn't actually work out as well as planned, right? I mean, that didn't go as planned, and we still came out okay. Uh,
Right.
Here's another example. A few months back, we partnered with a home builder in Tennessee who specializes in condominiums.
Which is so cool to me.
Yeah, so we partnered with him to build a handful of condominium projects, specifically 4 condominium homes together, and the projected annual returns on those is 16 to 20%, and the timeline for each build is pretty short. It's
Like,
around 9 months.
yeah.
So we're doing two simultaneously right now. Those will close out before the end of this year, and then we're going to do a second round of two more, and annualized we will be earning, hopefully, of course, but the projection, he's done this many times before. He has a solid track record, knows the numbers are pretty predictable. So 16 to 20% annualized returns on those silent partnerships that we made, again, with these real estate operators. Okay, moving on. Number 4, triple net, single tenant, industrial seller leaseback deals. I know that's a mouthful. I know it's a mouthful. So we've done a handful of these, working with operators who specialize in these kinds of deals. And I'll give a 10-second quick summary of how these work. So when an industrial company wants to raise money, often instead of taking out an expensive loan, they will sell off the property where they operate, where they run their business, and then they will lease it back. So it's a way for them to raise money to grow their business without having to take on debt. So we've invested in some of these deals with operators who specialize in this, where they buy the land and the industrial buildings where the company operates, and then they sign like a 20-year lease with them, and it's triple net. So the tenant, the company, the industrial company, they pay the taxes, they pay the property insurance, they pay for repairs and maintenance on the buildings, and for their machinery, et cetera. Um, so the landlord, if you will, the company, who we partnered with on these, they don't have to worry about any of that stuff. They just collect the rent on these industrial properties. So it's a great business model. It's a
Yeah.
fantastic business model.
We actually just had one that closed and it was like it had government contracts and all kinds of stuff. So, yeah.
Yeah, it was a commercial steel tank company that we invested in around 2.5 years ago, 3 years ago. And they just closed out about 6 months ago. And that closed out at an annualized return of 27.6%, which was lovely to see. Now, not all of that was income yields, right? Like a lot of that was profit on the back end when it went full cycle and sold. But I think for that deal, I think we earned 6% yield while that was under ownership. So not quite the 8% yield that we're talking about here. But we'll give another example. One that we just made about 6 months ago. It's a welding company,
Mm.
and they do things like put together ships for the Navy and stuff. And that has been paying out almost an 8% yield. It's 7.75%. So we're going to round that to the nearest percentage and call it 8% for the purposes of illustrating this point. But it's another one of those industrial seller leaseback deals, uh, paying around 8% in yield. And that pays out every month, actually. We get those distributions, which is pretty nice. Some of these pay out every quarter, which is fine too. Uh, okay, moving on. Number 5, multifamily syndications. So apartment buildings where you buy in as a minority owner of the property, basically. And we've
And
done a bunch of
truly, when we first started this, that was all I thought things were. That's all I thought you could do
with
with
syndication.
pass. Yeah.
Yeah, and of course, there's everything under the sun: industrial properties, mobile home parks, and we'll talk some more about some of these others as well. But yeah, multifamily is sort of the bread and butter in the syndication space. Yeah, so you with the syndication, if you're not familiar with that term, you buy in as a silent partner, you get a small equity ownership in the property, and then you get paid out returns accordingly. So here's two quick examples of this. We've actually done 3 deals now with this one operator who buys workforce housing, worker friendly, kind of blue collar apartment buildings in Cleveland, Ohio. And he actually uses the infinite returns model, which is kind of fun, where he buys these over the course of a couple years, he renovates them and raises the rents on the renovated units as they get nicer, and then he refinances that property after about 3.5 years, returns 100% of our investment capital back to us. So we get our money back, but we retain our ownership interests in that property and we keep collecting distributions and income indefinitely. So it's a great model. And in the meantime, even while he's renovating the units, we're still collecting 8% yield in distributions on these properties because they're still cash flowing well, even
Right.
as he's renovating these. So as tenants move out organically, they go in and they renovate the units to make them nicer, and then they rent them to a slightly higher level tenant and who charge more rent, et cetera. And over the course of 3 years or so, all these units turn over, they renovate them, they raise the rents, get better tenants in there or higher caliber tenants in there. Um, and all the while, we're still collecting 8% in distributions, which is really nice. Um, so that's one example. Second example, this was another one in the Midwest, actually. An operator who we've done a couple deals with. He bought this portfolio that was super spread out. It was spread over at least
Oh.
3 states, maybe 4. Indiana, Ohio, I think Illinois. I can't remember, but anyway, it was a very spread out portfolio of over 400 units that he bought, and because it was so spread out, he got a really good deal on it because no one else wanted to touch it because the management of these properties was going to be difficult, right? It was going to take a certain type of operator who could handle managing all these different units in all these different states, different cities, et cetera. And that has been overperforming since the get-go, largely because he got such a good deal on that portfolio of properties. So that's currently paying a 9.51% distribution yield. So, almost 10% distribution yield on that portfolio of properties, which is great, right? I mean, that's super fun to see every quarter, those distributions come in.
And this is without dealing with toilets and tenants.
Right. Yeah. We are simply passive investors in these deals, as someone else deals with like you said, the tenants and the toilets and the termites and all that stuff. Okay. Number 6, mobile home parks,
My
or
favorite.
more, yeah, or more, you know, practically, syndications with mobile home parks. If you don't want to actually go out and buy the entire park yourself, which most of us don't want to do or can't afford to do. So, here's a quick example. We invested in a mobile home park syndication, I don't know, 2.5 years ago, 3 years ago. It's
Mhm.
in Nebraska, and that is currently paying an outrageously high yield of almost 25%. It's a 24.9% yield currently. Now, that park has overperformed projections, of course. Yeah, that park has done well. But, it goes to show that when mobile home parks are well managed, they can perform really well. And one of the reasons for that is that it's the only asset type, real estate property asset type in the US that's shrinking over time.
Hmm.
No, cities don't want to authorize new ones to be built, so they don't. So there's a finite number of these around the country, and every year that number drops as people convert them to apartments or whatever. They'll go in and they'll tear everything down, they'll build an apartment building or something. But yeah, these mobile home parks can be super lucrative if you manage them
And
well.
they tend to be pretty good in any type of economy.
Right, it's the ultimate affordable housing, right? So in an economic downturn, where do people go? They go for more affordable housing. And they can be even more recession resilient because often the business model for these parks is to sell the homes to the tenants so that the park doesn't actually own any of these homes anymore. The tenants own the home. So if they if they default on their lot rent, then they have to pay to move the home out. And it's much more expensive to move a mobile home than it is to pay the lot rent.
Mhm.
So you have a built in protection there for rent defaults, even in a bad economy. Okay. Number 7, we're making progress. Number 7, vacation rentals like Airbnbs, boutique hotels. We've done a couple of these. One example is it's a boutique hotel in Southern California, up in the mountains, a couple hours outside of LA and San Diego, that pays. Let's see, the current yield is 16.7% that we are collecting on that. Now, in this particular case, the operator, they went in, they improved operations, and improved the occupancy rate for the cabins, for this boutique hotel. They started doing events like weddings and corporate retreats and stuff, and they were able to refinance that. They were able to grow the income by so much that they went out and were able to refinance after it was around 15 months, 15 or
Right.
16 months after buying it. And when they refinanced, they were able to return over a third of our money, our investment capital, back to us. They returned 35% of our investment capital back to us when they refinanced. So we got a chunk of our money back, our initial money back, and we're still continuing to receive distributions. Again, currently at a crazy high yield of 16.7%. And they are actually preparing to sell that property now as we speak. They're looking for an exit over the next couple months, which will have been around 2.5 years from when they first bought this boutique hotel. And the projected annualized returns for us in that deal is over 40%. Crazy high. So, anyway, just goes to show that, these deals are out there. Not every deal performs that well, of course. We've seen deals, you know, plunk, and we've seen them flop. Um,
There's risk. There's
there's
always
always risk
risk.
in any investment, but these types of investments can perform crazy well, and that's why we are investing in new ones every month in the co-investing club. Small amounts, new deals, dollar cost averaging, just month in and month out, putting small amounts in new deals, and growing the portfolio of having a lot of or small amounts of money spread across a lot of different deals. Okay, last but not least, fractional ownership in oil well. Now,
This blew my mind because there's this show called Landman, and when we first got into this, I was like, "This is real."
yeah. So, we are a real estate investment club. We are not an energy investment club. But that being said, we do occasionally branch out into alternative investments, like energy. So we did invest in it was a direct working interest in a cluster of oil wells in Texas. And this is a very different type of investment than the real estate investments that we typically make as an investment club. So in these cases, the way that you get returns is you get a share of the profits from the oil flow from these wells over the years of the well's lifespan, right? And then you don't ever sell it, right? I mean, because there's no, you just run it until it runs dry, and then it's kicked, right? So there's not like a sale in the way that there is with real estate properties where you get
Right.
profits upon the sale at the end. This is more immediate cash flow that's, slowly over time ebbs down. So that's the model here is, you drill the well, you start collecting cash flow from the flow of that well, and then you keep collecting cash flow over the lifespan of the well, which can be decades. Um, more likely, they start to really die down after 10 years in some cases, but they can run for 30 or 40 years and keep paying out. So, you know, with these types of investments, you typically calculate, what's the break even timeline. So, after how many years will I get my investment back? Will I ever recouped my initial investment? And then from there, it's all gravy, right? Like all the cash flow after that is gravy. So with that particular investment that we made in this working interest in wells in Texas, the projected annualized returns over the course of a 10-year period was 17% yield on that. So in the beginning, it'll probably look more like 25 or 30%, and then it'll drop down. And by the end, it'll just be a trickle. But that's
A
how
trickle.
yeah,
Yeah.
yeah. No pun intended. So that is the eighth and final one. So a quick recap here. Eight different types of investments paying 8 to 16% interest, private notes, which can be secured with real property, real estate funds, joint venture partnerships, silent partnerships, um, industrial seller leaseback deals, multifamily syndications, mobile home parks and syndications, vacation rentals or boutique hotels, which again, you can invest in a syndication. And then last but not least, fractional ownership in oil or gas wells. And then here's a quick bonus one that everyone always asks us about. They say, well, what if I just buy shares in a publicly traded REIT, a publicly traded real estate investment trust? And those are easy, right? Because you can just click a button in your brokerage account and buy some shares in them. And they're liquid. You can then turn around a day later and sell those shares if you want to. Now, those do have a high historical yield. So we ran the numbers. We went to REIT.com and we looked at the historical data going back to 1972. The average yield on publicly traded REITs in the US over that period was close to 8%. It was 7.76%. So, strong yield. Here's the problem with REITs is that they share an uncomfortably high correlation to the broader stock market because these are basically just another sector of the stock market.
Right.
And so you get no diversification benefit, basically, or very little diversification benefit by investing in REITs as your real estate investments. Because they're so closely correlated to the stock market that it defeats the purpose of trying to diversify into a new asset class like real estate. Because part of what we're trying to do is to have a portfolio of investments that don't move in lockstep with your other investments, right? So as
Right.
the stock market goes up and down, you don't want your real estate portfolio to also go up and down with the stock market. You want it to keep plowing forward regardless of what the stock market is doing. And that's the benefit of diversification, right? And you lose that with REITs. So, Denny, any final thoughts you want to add before we call this episode complete?
Well, I think that one of the things I do love about the club is, as you were talking about diversification, and we actually go out of our way to do that because economies, everything changes, and that's helps protect, a little bit more than if you were just to put everything in one place. And I also think it's awesome that we get together and we vet these deals together, sometimes 65, 70 people on a call from all different backgrounds. So they're asking some legal questions, accounting questions,
Insurance question.
management.
Yeah.
Yeah. I mean, so it's amazing to be able to have that as well, because I think that gives a little extra due diligence, and it makes I can't speak for you, Brian, but I know it makes me more comfortable to move forward in a lot of them.
Yeah, no question. You get the benefit of every other club member's experience and expertise in vetting passive real estate deals. And of course, you get the lower minimum investment, $2,500 or
Right.
more instead of the typical minimum for these types of investments, which is $50,000 to $100,000.
So
So
you're
that's
not putting all your eggs in one basket.
exactly. So, hope you got a fresh perspective from this episode. Subscribe to the show, pass it on to your friends and family members. And if you didn't get anything out of this episode, let us know. Support at sparkfunnel.com. And lastly, consider
Nice.
yeah, yeah, exactly. Uh, lastly, consider joining us in the co-investing club. We do have a free membership option where you can come in and sit in on deal discussions, see the kind of deals that we're looking at and vetting together as a club. And if you're not familiar with these types of passive real estate investments that we talked about today, which most people are not, we have a free course on that, sparkrental.com/free. It's 8 episodes. They're all super quick, like 5 to 10 minutes long. They just run you through really quickly how these investments work and give you some concrete examples of these. So on that note, stay weird, unconventional investor.